Did you know that according to the S&P Dow Jones Indices, nearly 90% of individual investors underperform the stock market over the long term? Or that emotional decisions during market downturns can wipe out years of potential gains? Most people enter the world of investing without a clear plan, falling victim to avoidable mistakes and myths that derail their financial goals. In this video, I'm going to share 5 powerful lessons from the book 5 Rules for Successful Stock Investing by Pat Dorsey. These are not just tips. They're timeless principles that can transform the way you approach investing. By the end of this video, you'll not only understand these lessons, but also know how to apply them to your own financial journey, whether you're just starting out or looking to refine your strategy. This isn't just about making money. It's about building a foundation for long-term financial success, avoiding costly mistakes, and taking control of your financial future. Number 1. Invest in companies with a strong economic moat. An economic moat refers to a company's ability to maintain a competitive advantage over its rivals, much like a medieval castle surrounded by a moat for protection. This concept was popularized by Warren Buffett and is a cornerstone of Pat Dorsey's investment strategy. Companies with strong moats are better equipped to preserve profits, fend off competition, and sustain growth over time. Moats can take different forms. Brand recognition. Companies like Coca-Cola or Apple, whose names evoke trust and loyalty. Cost advantage. Businesses that can produce goods or services cheaper than competitors, such as Walmart. High switching costs. Companies like Adobe or Microsoft make it difficult for customers to switch because of the inconvenience or expense involved. Network effects. Platforms like Amazon or Facebook become more valuable as more people use them. By investing in companies with strong moats, you reduce the risk of your investment being undermined by competition or market changes. Imagine you're deciding between investing in 2 companies, a local coffee shop chain and Starbucks. The local chain has no significant advantages. It's competing on price and location, but lacks brand power or loyalty. Starbucks, on the other hand, has a powerful brand, international presence, and loyal customers willing to pay premium prices for its products. Starbucks has a clear economic moat due to its brand and scale. This makes it more likely to maintain and grow its profitability over the years. When considering an investment, ask these questions. Does this company have a product or service people are loyal to? Is it hard for competitors to replicate what this company does? Does the company have a track record of weathering competition or market downturns? To practice identifying moats, start observing the companies you interact with daily. Think about why you choose certain brands over others. Those reasons often point to a moat. Number 2, focus on quality, not just price. It's tempting to buy stocks because they seem cheap, but a low price doesn't necessarily mean a good investment. A company's stock price reflects its market value at a given moment, but the true worth of a company lies in its fundamentals. A high-quality company with strong financials, a proven track record, and solid growth prospects will outperform a cheap company with shaky foundations in the long run. Key factors to look for when assessing quality include strong financial health. Look for low debt, consistent revenue growth, and healthy profit margins. Management effectiveness. Assess whether the leadership is experienced, shareholder-focused, and transparent. Industry leadership. Companies that dominate their markets or hold competitive advantages tend to maintain stability. Sustainable growth potential. Consider whether the company has room to grow in its market or expand into new areas. Quality companies can weather market downturns better and recover faster, making them safer and more rewarding investments. Imagine you're choosing between 2 companies. Company A has a stock price of $5, but its financials show high debt, declining profits, and a history of poor management decisions. Company B has a stock price of $50, but it has low debt, a strong market presence, and consistent earnings growth. While Company A might seem like a bargain, investing in it could lead to losses if its financial troubles worsen. On the other hand, Company B offers a more reliable and potentially lucrative opportunity, despite the higher initial cost. Before investing in any stock, perform a quick quality check. Research financial metrics. Use online tools or platforms to review metrics like the price-to-earnings ratio, PE, debt-to-equity ratio, and return on equity, ROE. Understand the business. Make sure you can explain what the company does and why it's successful. If it's not clear, it might not be a quality investment. Ignore short-term noise. Don't be swayed by sudden price drops or hype. Focus on the long-term potential of the business. This disciplined approach ensures you're not buying something just because it's cheap. You're investing in quality that can deliver sustainable returns over time. Number 3, understand the industry dynamics. Investing without understanding the industry is like sailing without a map. You might move forward, but the risk of getting lost is high. Industry dynamics refer to the forces, trends, and factors that influence how businesses in a particular sector perform. These include trends, emerging technologies, consumer behavior shifts, or regulatory changes. Risks, potential disruptions such as new competitors, declining demand, or policy shifts. Opportunities, growth areas within the industry, such as expanding markets or innovation. Understanding these dynamics helps you evaluate whether a company is positioned to thrive in its environment. For example, a technology company with cutting-edge products might perform better than a traditional competitor in an industry transitioning to digital solutions. Imagine you're interested in investing in electric vehicles, EVs. The industry is growing due to increasing environmental concerns and government incentives. However, a deeper look reveals challenges. High competition from established automakers entering the EV market. Dependence on the supply chain for raw materials like lithium. Rapidly changing technologies requiring constant innovation. Armed with this knowledge, you might choose to invest in a company with a robust supply chain and strong R&D capabilities instead of a smaller player struggling to compete. To understand industry dynamics effectively, follow these steps. Stay informed. Read industry reports, news, and financial analysis from reliable sources. Websites like Morningstar or industry blogs can provide valuable insights. Identify key players. Understand who dominates the market, who's emerging, and who's struggling. This helps you evaluate competition. Watch trends. Look for patterns in consumer behavior, regulatory changes, or technological advancements that could impact the industry. Ask questions. For every company you research, ask, how does this company compete within its industry? Is the industry growing, declining, or stable? What external factors could impact this company? Example for personal investment. Suppose you're interested in investing in healthcare. Start by identifying key trends like telemedicine growth or aging populations driving demand for specific services. From there, research companies leading in these areas and evaluate their ability to capitalize on these trends. This informed approach helps you avoid poor investments and spot long-term winners. Number 4, think long-term and avoid short-term market noise. The stock market is inherently volatile, with prices rising and falling in response to news, investor sentiment, and market speculation. Short-term price movements can create anxiety and lead to impulsive decisions, such as panic selling during a downturn or overpaying for a stock that's momentarily popular. Successful investing requires focusing on the long-term fundamentals of a company, such as its profitability, growth prospects, and competitive advantages. These are the factors that truly determine a company's value over time, not the day-to-day price fluctuations influenced by unpredictable factors. By thinking long-term, you not only avoid the emotional roller coaster of short-term volatility, but also position yourself to benefit from the compounding growth of your investments. Let's say you invest in a strong company with a proven track record, like a global technology firm. Suddenly, the stock price drops 10% in a single day due to negative market sentiment following an unrelated tech sector news story. If you focus on short-term noise, you might panic and sell, locking in your losses. However, if you analyze the company's long-term fundamentals and recognize that its business model remains solid, you'll likely decide to hold or even buy more shares at a discount. Over time, as the company grows, its stock price could recover and exceed your initial purchase value. To think long-term and tune out short-term noise, you need to set clear goals. Define your financial objectives, such as saving for retirement or a child's education, and align your investment strategy with these goals. Monitor fundamentals, not headlines. Regularly check the financial health of the companies you've invested in rather than reacting to sensational news. Avoid overchecking portfolios. Limit how often you review your portfolio to prevent overreacting to temporary fluctuations. Checking quarterly or biannually is often sufficient for long-term investors. Practice patience. Accept that some investments may take years to fully realize their potential. Resist the temptation to jump ship during challenging times. Example for personal investment. Imagine investing $1,000 in a renewable energy company. A week after buying, a sudden shift in oil prices causes renewable energy stocks to decline. Many investors panic and sell, but you decide to hold because you believe in the long-term growth of clean energy. 5 years later, as the world increasingly adopts sustainable practices, your $1,000 investment has grown to $3,000. This demonstrates the value of ignoring short-term noise and maintaining a long-term perspective. Number 5, diversify your portfolio. Diversification means not putting all your eggs in one basket. In the world of investing, this principle involves spreading your money across different sectors, industries, and asset types to reduce the risk associated with any single investment. While individual stocks or sectors can experience significant downturns, a diversified portfolio is more resilient to these fluctuations because gains in some areas can offset losses in others. Diversification doesn't eliminate all risk, but it minimizes the impact of a poor-performing investment on your overall portfolio. For example, investing in technology, healthcare, consumer goods, and energy stocks ensures that a slump in one sector won't disproportionately harm your financial position. Additionally, including a mix of assets, such as bonds or index funds, can further stabilize your portfolio. Imagine you invest all your money in a single tech company. If that company's stock price drops significantly due to a new competitor or regulatory changes, your entire portfolio suffers. However, if you spread your investments across tech, healthcare, retail, and renewable energy companies, the decline in the tech stock would have a smaller overall impact, as the other sectors might remain stable or even grow during the same period. Practical tip for everyday use. Use index funds or ETFs. These funds inherently offer diversification by tracking entire market sectors or indices, such as the S&P 500, instead of individual stocks. Invest across sectors. Allocate portions of your portfolio to different industries like finance, technology, healthcare, and energy. Consider geographical diversification. Include international stocks to benefit from global economic trends and reduce reliance on one country's economy. Balance risk levels. Pair high-risk, high-reward investments with safer, more stable options like bonds or dividend-paying stocks. Example for personal investment. Let's say you have $10,000 to invest. Instead of putting all of it into a trendy tech stock, you split it. $3,000 in a tech-focused ETF. $2,000 in a healthcare ETF, $2,000 in a consumer goods ETF, $2,000 in bonds for stability, $1,000 in international markets for geographical diversification. If the tech sector faces a downturn, your losses there may be offset by gains in healthcare or consumer goods, ensuring that your portfolio remains more stable overall. By diversifying your portfolio, you minimize the stress of market fluctuations and position yourself to achieve steady, long-term financial growth.